Assalamu alaikum students. Hi everyone. This is your tutor Saad Muhammad for the Advanced Taxation webinar. I welcome you all on the fourth day of Practice to Pass webinar. Can everybody raise their hands if they can see my screen clearly and hear me? Thank you, Bala. Thank you, Rajaram. Okay, guys. So, guys, as we have discussed yesterday, that today, the fourth day, I have dedicated to the 35 mark question from section A, and I'll remind you that as per examiner's instruction, there will be a 5 mark part in either question A or question B. It is not specific that whether question A will have it or question B will have it, but there will be a 5 mark requirement on ethics on both questions, in one of each question, sorry. But it will be there in section A. So we'll be discussing about ethics as well, because both of the questions that I have selected for you today are from one of the part of them belongs to ethics. Secondly, guys, I'll remind you that I have discussed with you that the question number 1 can either be tested on individual taxes, that is income tax, capital gains tax, inheritance tax, and there can be a value added tax part as well. Or it can also be tested on corporation tax and VAT. So the question that I have selected today for you, one belongs to individual taxation and one belongs to corporation tax. And during that question, we'll study some important topics as well that are very common in advanced taxation. So before I continue, I would like everybody to raise their hands and give me a go ahead that they're ready. Okay, guys, thank you. So I'll skip my introduction as all of the students are here from yesterday's session. So as per our plan, the two questions that I have selected today, the question number 1 is from September-December 20 attempt. The name of the question is Lamar. Obviously, it will be the question number 1 as it is a 35-mark question. And the second is Grand Limited. As the name suggests, it will be on corporation tax primarily along with VAT. It is from September 18. Both of the questions can be found on the practice platform where the examinations or these attempts have been updated to the latest Finance Act. And you guys now know as to how to find their answers as well. Along with that, both of the questions can be found in the Kaplan's examination kit as well. So before I move on, if anybody has any question, they can ask in the question box. I'll try to answer along with the question. Few of you have asked me, sir, that from where can we can find the practice to pass examiners read the mind of the marker article. So today I'll show you on my screen that from where you can find the read of the mind of the marker article. So if you click on advanced taxation, if you visit the advanced taxation tab, here you can find paper exam technique or the CBE technique. So I'll click on paper exam technique. Here you can find ATX UK read the mind of the marker. If you click on that, a PDF will be downloaded. If you click on that, the article will open. So this is the read the mind of the ATX UK marker. Now the question that the examiner has selected is the same that I have selected for you, that is Lamar from September-December 20 attempt, which is the latest attempt available on the ACCA website for the ATX UK exam. The article has been updated to the Finance Act as well, and the question available there in the practice platform has also been updated to the Finance Act 2020. After I go through the question with you, We'll study the practice to we'll study this ATX read the mind of marker article as well. So I can tell you that what are the keywords that the examiner is looking for, and the examiner has now told you himself that what are the key points that you should keep in mind to score good marks and to ensure that you pass the question. So here he has not only provided us with a good answer, but he has also provided us with the okay answer. So after reading this article, you can rate yourself after attempting every question that whether your answer was good or was it okay one. Now, here you can see on the ACCA practice to pass platform or the CBE platform that I have opened the ATX December 2020 paper. It is clearly written here that it has been updated to 2021 syllabus. Now guys, do remember one thing while approaching section A, that in section A you can find 9 easy marks that you can obtain without incurring any extra effort if you have the right approach. That is 4 professional marks and 5 ethical marks. So if you follow these 2 easy marks, you can score 9 marks out of 50. And guys, do you know how much 9 marks means? It means 18% of the total marks that you need to pass the paper. So imagine if I tell you that you only have to take 32% marks to pass the paper. The criteria or the paper marks have been changed from 50 to 32. How would you have feel? Obviously great. So do remember, approach the paper in a sense that okay, I'm going to take these 9 marks first, or the maximum amount of these 9, and then I'll try to score marks from the other parts of the question. Along with this, in question number 1 or question number 2, that is the 35 mark question or the 25 mark question, always you will find one part for whose requirement is small, and you can easily obtain marks in that if you have the knowledge about that topic, and the requirements are not usually that tricky for that part only. However, there will be one requirement with the maximum marks, and this will be the most trickiest one. So I'll suggest you to approach the paper in such a way that your focus should be on easy requirements, not the tricky ones. And in tricky ones, you should try to get away with maximum marks rather than scoring absolute full marks in them. Secondly, do remember these will be the requirements, the bigger ones, the one with the biggest marks or the maximum marks, that will take your time the most. So if you want to improve your time management, be alert while solving these requirements, the one that have the maximum marks. For example, if I'm attempting a question and there are 3 requirements and there's one requirement with 12 marks, the other one is with 8, and the third one is with 5. So I'll be conscious about the 12 one that it may, you know, ruin my time management or disturb my time management. So I shall be alert while solving that 12 mark requirement, and I shall be conscious that if I can easily take the 5 marks from the requirement C, the remaining marks that I need to pass the question out of 25 is the total marks that you need to pass the question is 13. If you have taken 5 out of that, so the remaining marks are 8. So I'll be focusing that how can I take 8 marks at least from first 2 requirements. So try to break the paper in smaller chunks and try to think like I'm trying to teach you. Now I'll approach the question Lamar. First of all, you'll have the preface in front of you, in which you can find the basic requirements regarding the question. So your manager has received an email from Lamar. Lamar is the MD and majority shareholder of Rep Limited. Okay. Lamar and Rep Limited are clients of your firm. So the individual is our client as well as his company. Your manager has forwarded the email to you together with an email detailing the work you are required to do. The following exhibits available on the left hand side of the screen provide the information relevant to the question. Email extract from Lamar, dated 7th September 2020, the first exhibit. And the second exhibit is email extract from your manager. Now, always the email extract from my manager will be the extract in which I can find the requirements in a detailed manner. And if I click on the requirement, it will just tell me the marking scheme. Now, if I quickly click on the requirements to know the marking scheme, the first one, knowledge obtained from advising other clients. I guess this will be the part that belongs to ethics. So the 5 mark requirement that I was looking for, I have found that. The first one relates to ethics. Second is investment in J Limited, under which there are 2 further requirements. Residency of J Limited, the requirement with the most marks, I guess, till now. Election to be exempt the profits of J Limited's overseas permanent establishment from the UK tax. 3 marks. I guess that if you know the concept of the election from the profits of overseas establishment, you can easily take these 3 marks. Controlled foreign company rules. If you know about CFC, how does it work, why the rules are there, you can take these 3 marks as well. C. Purchase of the property might be a part that may deal either with IHT or CGT, can be related to income tax as well. Proposed gift of shares. This part may relate to IHT or CGT. To trust, it means it belongs to IHT, not CGT. Because gifts to trust are exempt from CGT, they're the part of IHT domain. The CGT domain does not interfere in the gifts to trust. That's why they're exempt from that. 6 marks. Professional marks will be awarded for the approach taken to planning the content, the clarity of the explanations, calculations, the effectiveness with which the information is communicated. Now, do remember that out of 4 marks, only 2 marks are normally for that how good you have presented the answer, how well your language was and presentation. However, 2 marks are always for the format. For example, if I'm preparing notes for the meeting, my format will be client, and I'll write the name of the client. Then purpose, I'll write whatever the purpose is. Prepared by, I'll write whatever I am in the question, tax manager, tax senior, consultant, whatever. Date, that will always be the exam's date. Or if it is mentioned that imagine that today's date is this. Now do remember this one change that I guess I have told you before as well, that from now onwards you do not have to assume that today is the exam's date. The date will always be mentioned in the question, that you should assume that today's date is this. So you'll write that date in the format of notes of the meeting. Now, before starting reading the question, I can click on the extract from my manager, which will have the requirements in better detailed manner. I want you to lead the meeting. You should therefore set out the notes in manner which will make it easy for you to refer to them during the meeting. Okay, fine. Knowledge obtained from advising our clients. We have a number of existing clients which trade from permanent establishments situated overseas. And a few years ago, we had a client with a presence in the country of Garia. Set out the points you'll make in order to explain the extent to which a rep limited can benefit from the knowledge we have gained from advising these clients. So I can have an idea that about what I have to talk about, but it will be more clear when I'll read the question in full. Investment in J Limited, Rep Limited and CRO Limited are UK resident company. I do not know who CRO is. Business profits are generated in Gari are subject to 13%. There is no double taxation treaty. Then there is a requirement relates to residency of J Limited. I'm just having a quick overview or a quick recap of what is being asked in the question. Okay, then the C is regarding CFC rules, purchase of investment property. Then D relates to the gift of the trust, that is the part that relates to IHT. Okay guys, let's now read the question first and then we'll read the detailed requirement that are in the email extract from my manager. We'll read them later on. Guys, before I move on to the question, if anybody has any questions, they can ask in the question box. Okay, so I guess that you are all ready. Now, let's discuss the question. Potential investment in J Limited. We are in discussion with the management of CRO Limited regarding the establishment of a new company, J Limited. If it proceeds, J Limited will commence trading on 1st April 2021 and carry on its business activities in the country of Korea, where it will manufacture computer components. So now I know that my company, that is Rep Limited and CRO Limited, are planning to open a company called J Limited. And this country will be operating mainly in the country of Garia, where they'll be manufacturing computer components. So the CRO Limited is proposing that Rep Limited would own 30% of the ordinary share capital of J Limited. Okay. And CRO owning the remaining 70%. However, we regard this potential investment as somewhat risky, such that if we decide to proceed, we may prefer to own just 20% of J Limited rather than 30%. Okay, so there are two proposals, me owning 30 and they owning 70, or I owning 20, they owning 80. Okay, J Limited is expected to be profitable in the year ended 31st March 2020, that is their first year of business. However, there is the possibility that it will be loss making in either that year or in the future years. Okay. J Limited tax adjustable trading profit for the year ended 31st March 2022 is budgeted to be 135,000, all of which relates to its activities in Garia. J Limited will have no other source of taxable income and will not make any chargeable gains during this year. We have not been involved in joint venture like this before, and we have no experience of carrying on a business outside the UK. We would appreciate your advice on the following three extracts from the documentation provided to us by CRO Limited. So Rep Limited and Lamar are asking for our expert advice because they have no previous experience of a joint venture like this before. First, it has not yet determined whether J Limited will be resident in the UK or in Garia. If J Limited is resident in the UK, it will be considered to be carrying on its business through a permanent establishment in Garia. Okay, so guys, I'll stop here and I ask you that what will be the tax consequences? Let's say if a company is resident in the UK and they have a permanent establishment overseas, and they are trading through that permanent establishment, will the profits from that permanent establishment will be taxable in UK? Answer me in yes or no, guys. Okay, Johannes thinks yes. Anybody else? Fawad thinks yes as well. Ashik thinks yes as well. Okay, guys, you all are right, and I want to tell you a one key concept that will help you always. Whenever the company is UK resident, its worldwide profits are taxable to corporation tax. However, if the country is on operating in such a country with which HMRC does not have a double taxation treaty, you can get DTR, that is double taxation relief in the UK. That is lower of the tax suffered in overseas versus if the tax would have suffered in UK. That is CT at 19% versus the rate in overseas. Whichever the lower, you can deduct that from your CT liability as a DTR. So one thing Rep and Lamar should remember that if the J Limited will be resident in the UK, the profit that will arise in Garia will subject to corporation tax. Second, if J Limited is resident in the UK, we will consider making an election to exemption its overseas trading profits from UK tax. Now, I just want you to raise your hands who know that there is an election that you can make to exempt your overseas permanent establishments. Only one student has raised hand. I guess all other students don't know. Okay, Ashik knows as well. So two students. So I'll take you to my notes, guys. Johannes knows as well. Thank you. And in the corporation tax chapter, that is the second last chapter, there you can find that there's a section in which you can find different topics in the group of companies, loss relief from overseas group. Under that, if you scroll down, there's a consortia topic as well, which will be tested later on. So do remember that as well. Or you can quickly just find out permanent establishment. Okay, guys, I forgot exactly where I have written in these notes. However, I'll tell you there is an election that a company can make if they are resident in UK and they have permanent establishment in other parts of the world. Now, what does that election mean? That election means that despite of being resident in UK, that company can still get away with corporation tax on the profits that are being earned overseas. Now, why HMRC has allowed that? Guys, you know that London Stock Exchange is one of the biggest stock exchange and companies would like to go there and list themselves. And UK is one of the attractive places to open a head office of your company. So the companies will be reluctant if you try to annoy them with heavy taxation. So the UK government, in order to promote companies, has done what? That they have made this rule that companies do not get annoyed by heavy taxation and will be reluctant to come into the UK and being taxed at 19%. So if the HMRC would not have announced this rule, the company would have opened their head offices in the countries in the states like Dubai, where there is either no taxation or a very low taxation. And there are several companies that do prefer Dubai still, and some other countries which have a lower amount of tax rates and some generous rules regarding the taxation. So what HMRC has does that HMRC has allowed the companies that what they can do is if they are resident in the UK and then they are operating through a permanent establishment overseas, they can submit an election to HMRC and request that they want to exempt all of their establishments all over the world from UK tax. Now, there are some conditions along with that. If you opt for this election, you have only 6 months cooling off period, after which you will not be allowed to revoke this election back. It will be irrevocable. Number one. Second, if the loss arises in that permanent establishment, you will not be allowed to claim the loss in the UK because HMRC is not, taxing you on the profit. So why will they allow you the loss to be claimed? So no loss will be allowed to claim against UK corporation tax. And if you make election today, all of your future permanent establishment which you may open in some countries will be bound by this election as well. So it will apply to all future permanent establishments of yours. Okay. Again, number one, if you apply for that, after a 6 months cooling off period, it will be irrevocable. Okay. Number one. Number two, if there will be any losses, you will not be able to adjust them against the UK profits of your UK company. Number three, it will be applicable for all of your future permanent establishments. Any issue? Any question? Okay. So guys, I guess you have understood that what will be the consequences of the second option. I'll take you back to the question. We have been advised that if J Limited is resident in Garia, this will not result in a charge under the CFC rules. We'll study CFC rules in a bit. Purchase of investment property. We are considering the purchase by R Limited of a new unused commercial building for 200,000 plus 20% value added tax. Okay. Rep Limited will then grant a 20-year lease of this building to a retailer. Will Rep be able to recover the VAT charged by the vendor on the sale of this building? Now, obviously, when Rep Limited has bought the building, they must have suffered 20% input VAT on this building. Now, if they lease it out to someone on a 20-year lease, my question to you is that can they charge him the output VAT and recover their input VAT out of it? Tell me yes or no. Come on, guys. I'll be needing answer yes or no. Okay, Johannes, it depends on what? Now, let me first take you to the notes and tell you that what is the VAT status of buildings normally. So you have to go to the VAT chapter. Underneath, there's a chart for the buildings. Now, this chart will help you understand if you buy a commercial building and it is a new commercial building, that building is considered as a standard rated taxable supply. So if you are selling to someone, you will charge 20% VAT. If you have bought the new commercial building, you have to suffer 20% input VAT. For 3 years, the building will be considered as a new, and if within 3 years you sell to someone, you can charge VAT and recover your input VAT. However, after 3 years, the building will become exempt automatically unless or until you opt to tax. Opt to tax means that you apply to HMRC specifically that you don't want this building to be exempt. You want it to remain chargeable. Otherwise, it will be exempt. Now, that is one thing about the commercial building. If you give the building to someone on a lease of more than 21 years, it is considered to be zero rated. Or if it is a sale of a residential building or a charitable building, it will then also be zero rated. If you give a lease to someone less than 21 years, it will be an exempt supply. Or after 3 years, if you do not opt to tax, the building will become exempt. Now you know that what happens with buildings at different times of different nature. Now you tell me that if Rep Limited grants a 20-year lease, can they recover their input VAT? Now answer me in the question section. Thank you, Fawad. More answers, please. Come on, Ashik, Bella. So guys, the answer is no. Why? Because the lease less than 21 years is an exempt supply. So on exempt supply, you cannot charge VAT unless or until you opt to tax the building. If you opt to tax the building, then what happens? The next thing is, if you opt to tax the building, then what happens? Then on the lease rentals, you have to charge output VAT to your tenants, which means if you are charging lease rental of 100, from now onward, you have to charge 120. That is 20% VAT on top of that. Now, if your tenants are VAT registered, they'll not have an issue. Why? Because they are VAT registered, they're gonna claim this as an input VAT. So you charge them or you don't charge them, it doesn't matter as long as they are VAT registered. If they are not VAT registered, they will complain because suddenly their cost jumps by 20%. That is one thing. The second thing is, again, for this opt to tax, there is a cooling off period. In that, you can revoke the election, you can take it back. If you do not, then your building will be taxable for the next 20 years. So, for opt to tax, if you take the exemption, that's fine. If you opt to tax, then you have first 6 months to decide that whether you want to keep it or not. After 6 months, it will automatically be taxable for the next 20 years. Okay. Now, coming back to the question, I will tell Rep Limited that if they will opt to tax the building, then they can charge the VAT to their tenants on the lease rentals and hence recover their input VAT. However, if they don't, it will be an exempt supply. Then I will tell them the consequences, that the consequences will be that after the initial cooling off period of 6 months, they will not be able to withdraw the elections till 20 years have elapsed. Now, if they opt to tax the building and whenever they sell it to someone else, let's say they cancel the lease contract and they sell the building to someone, or within 3 years they sell it to someone, as this being a new commercial building, it is a standard rated supply, so they should charge VAT to someone who they sell the building to. Okay, so do remember that if they opt to tax after 3 years, the building will be standard rated. If they don't, then the building will be exempt. But in the first 3 years, it will be standard rated anyways. So the exempt or the standard rated thing will be after 3 years, on then which it depends that whether you opt to tax or not. So that will be the answer to this thing, purchase of investment property to Rep Limited. And I'll suggest that you should write bullet points. We'll see that how much marks are there for this requirement and then we'll decide. Moving on 1st November 2020, I am planning to give 20,000 of my shares in Rep Limited to this trust. And I have established the discretionary trust for the benefit of my nieces and nephew. Okay, so he's going to establish a trust, or he already has established a trust, and he's going to give 20,000 shares in Rep Limited to this trust. So guys, obviously, will it be a pet or a CLT? Will it be a pet or CLT? CLT. And because it will be a CLT, will there be any lifetime IHT implications? Yes, they will be. Then will we be paying the 20% tax or the 25% tax? It depends, guys. Who will bear the tax? If the Rep Limited or the Lamar bear the tax, then it will be 25%. If trustees bear the tax, then it will be 20%. Now, moving on, I have made the gift. I will still own 60% shares, that is the 60% of the company. Okay, so after giving 20,000 shares, he will still be owning 60% shares, that is 60,000 shares. It means that 20,000 will most probably be representing 20% of the holding. So if I can see that he has 80% of the shares before and now he has 60% of the shares. You have already advised me that these shares are not relevant business property for the purpose of BPR. So we have already told him, so they will not be telling him about the BPR anymore due to the investment activities of Rep Limited, because company needs to be a trading company for BPR. Accordingly, I am aware of the gift on 1st November 2020 may result in IHT liability. So he knows that there will be a tax if I decide to make the gift. I will pay any IHT due. So guys, he will be paying any IHT due, which means 25%. It is obvious now. I have made the following gifts in the past. Guys, if I have to calculate the IHT on the shares, why shall I need the amount of gifts that he has made in the past? Can you tell me? Why is it even relevant to me? Guys, always remember, whenever we have to, yes, Fawad, thank you, Johannes, thank you. The reason is that we always have to check, because it is a CLT, it will utilize the nil rate band. So we have to check that if he has made any CLTs in the past because he's alive, so only CLT would have used the nil rate band. So if he has made any CLT in the past, it will reduce the nil rate band for this CLT. And in the past means in the last 7 years before this transfer. So you guys are absolutely right. Thank you. Now, these are the gifts that he has made in the past. All of the pets I'll ignore, only I'll consider the CLTs. So the first one is CLT, but if I stand on 1st November 2020, this is more than 7 years old. So I'll not consider this one. This is a cash to brother, so this is a pet. This must not have used the nil rate band. Then additional cash to trustees on May 2016. Guys, this is the CLT that I'll be considering because it is within 7 years and it is a CLT. Then a recent gift of cash to sister, again it is a pet, so I'm not gonna consider this as well because pets don't use nil rate band because they are not taxable in the lifetime. They are only taxable at the death. That too, provided that the death happens within 7 years of making a pet. Now, so I know that here for the assets that vary in value at different levels, I do not calculate the value straight away. Rather, what I have to do, I have to calculate the value or the wealth before transfer and the wealth after transfer. The difference I'll take as a transfer value. Then I'll deduct the relevant exemptions and then nil rate band, and any remaining amount above the nil rate band will subject to 25% of the IHT. Okay. Now let's read the requirement, the email from my manager, because they'll be including the detailed requirement. So in the first part, knowledge obtained from advising other clients, this part's relate to ethics. If you go into my notes, separate section for ethics, I told you yesterday as well. In the last of the income tax, you can find that. Sorry, these are the ethics notes. There you go. Prospective clients, conflict of interest, HMRC errors, avoidance and evasion, and money laundering. These are the 6 types. However, this question asks about the conflict of interest. Now, why there is a conflict of interest? There is problem that we have also acted for one of the clients that are in Garia as well, and they were conducting the similar operations. So they are sort of their future comparator because they'll be dealing in the same country in the same type of the business. So what are the facts that I have to be careful about? Guys, you remember that you have studied the ethical principles in other papers. I always remember them with a mnemonic called COPY, COPPI. C stands for confidentiality, O for objectivity, 1P is for professional competence and due care, 1P is for professional behavior, and I for integrity. So use that mnemonic to learn the principles. So two ethical stances are at stake here. The first is confidentiality. If we work for the two types of parties that do the similar nature of the business, we have to make sure that we do not breach confidentiality while working for both. We can advise both companies by telling them that we are working or acting for both. However, we are strictly prohibited to disclose anything. So we should make sure that confidentiality is one of the fundamental principle of ethics and we should not breach. Secondly, for this type of assignment that is specialized of nature, always talk about the professional competence and due care. That this principle requires individuals or the professionals like us that they should keep updating their knowledge regularly in order to provide the client with the most updated services available. So we should make sure that before accepting this assignment, do we have the relevant amount of expertise and knowledge to provide these services? Otherwise, it will be unfair to engage into these services if we are unable to provide the services of such nature of quality to the client. So by mentioning these 2 points, the confidentiality and objectivity, and explaining it further, confidentiality and professional competence and due care. By explaining these 2 points further, you can easily score 5 marks. Even if you do not know about anything other in the requirement or in the question, at least you can score these marks. Now, moving back to the question, investment in J Limited. Rep Limited and CRO Limited are UK resident companies which are to prepare accounts 31st March each other. Business profits generated in Garia are subject to 13%. Okay, that will be relevant when I'll be calculating the DTR, guys. There is no double taxation treaty between UK and Garia, so obviously DTR will be available because the tax is being taxed twice. Residency of J Limited. Explain of the relevance of the country of the residence in J Limited. 2. The amount of UK corporation tax payable in the UK and Garia in respect of its profits. The relief available to Rep Limited by J Limited business in Garia were to make a trading loss. Before you start, take some time to identify the different possibilities which need to be addressed, recognizing that we do not know yet what percentage of J Limited will be owned by Rep Limited. Now, what does this mean? It means that they have proposed two structures that either we can own 30% or we can own 20%. So I have to talk about both scenarios because he has clearly identified that we don't know that which option we will choose. So it is 4 possibilities now. J Limited can be resident in the UK, J Limited can be resident in the Garia. On top of that, there are further 2 possibilities in each scenario, we owning J 20% or we owning J 30% in either option. So let's start discussing all of the option. For that, I will use the word processor, and if I were to write, it's part B and I'm talking about part 1. I can bold these both for the examiner's convenience. Now, the first heading I would have given that J resident in UK. J resident in UK. Now, what would have happened if the J is resident in the UK? I'll explain to you with bullet points. However, if you were to write, you will explain it in bit further detail. If J Limited will be resident in UK, tax on profits from Garia, but DTR will be available. Now, I can also make a quick calculation by checking that how much profits have were to be make. I'll open the question. Let's quickly check 135,000 profits I will make or the company will make in their first year. So the DTR will be CT at 19% times 135,000, that is 25650. However, less DTR at 13%, that was the rate that is applicable in the country of Garia. I will then go back, multiply 13% with 135,000, that is 17550. So the difference will be CT payable in UK. You could have done a quick calculation, that is 135% multiplied by 19% minus 13%. That is, you should have taken a direct 6%. That can be a quicker approach as well. And I'll suggest you in the CB exams to use that approach because you are already struggling with the word processor and the spreadsheet. So rather than, taking a longer route, go for the quicker approach. Okay. So the savings will be minus 26 sorry 25650. 8100 will be the not savings, rather the payable. That will be the CT payable if J will be resident in Garia, UK. However, now let's talk about the loss situation. If rep owns 30%, that is one scenario, and if rep owns 20%, that is the second scenario. Okay guys, now you tell me that is there any difference if rep owns 30% or if rep owns 20% according to the loss relief? Will it be okay, Tarek? What will be the difference then? You tell me, please. Any other student who knows the difference? Guys, I hope that you have heard about consortium companies or consortia. Consortia means that one company is owned by two or more companies, with no company owning more than 75%. Because if any company owns more than 75%, obviously it will become the gain group member of that company and loss relief group member of that company. So the holding should be less than 75%. No one owning more than 75%, and no one has less than 5%. If these three conditions can be fulfilled. Number one, two or more companies own the same company. No one owns less than 5%, no one owns more than 75%. If these three conditions are fulfilled, then it is called a consortia company. What is the matter with consortia company? If the company is a consortia company, it can surrender losses to its owners in their respective portion of ownership. For example, if one company owns it 30% and the other company owns it 40%, it the total is 70%. So it can surrender loss 30% to the one that owns 30% and 40% to the one that owns 40%. So I'll state here that if rep owns 30%, J will be a consortia company and J will be entitled to 30% of losses. Now, if owns 20%, then obviously the other company, CRO, will be owning the company more, that is 80%. Now, CRO owning our company 80% will make the company its loss relief group member because it will be owning the company more than 75% directly. And we, being the non-controlling interest, will not be able to get any loss. All of the loss will be attributable to CRO. So it will be loss relief member of CRO. No losses available to us. Okay, so this is the first scenario in which I've discussed the two ownership possibilities, that J being resident in the UK. Now, J resident in Garia. Now guys, what if J resident in Garia? It will be a non-resident company. Non-resident, you can write permanent establishment of rep. Now, if rep elects for exemption of overseas permanent establishment, that is PE, no CT payable in UK. Any dividends that rep receive from J will be taxable. Guys, dividends that I receive from J will be taxable. Our intra-group dividends are taxable. Johannes, you're wrong. Intra-group dividends are not taxable. Okay, so they will not subject to UK corporation tax. The answer is no. They will not be taxable to corporation tax. Now, if we don't elect, obviously what will be happen then? Well, that we owning the 30% and they owning the 20%. In that case, as we have exempted, so if the losses, we can write here that the losses will not be adjusted against UK profits after election. Okay, guys, any issues? Now, using this, I have tried to explain to Rep and Lamar that what are the consequences, different consequences of different possibilities. Obviously, do remember, guys, if it is a non-resident company, it is not even owned by any company from the UK. It is entirely a non-resident company. It has no connection with UK companies. Then it will not be subject to any corporation tax in UK. Only the permanent establishments that are owned by UK resident companies are subject to UK taxes. Even they can be get exempted after applying an election. And I told you about the consequences of the election. Before I move on to the next part, if there is any question you guys want to ask, I would quickly like all of you to raise your hand so that I can have a quick idea that you have understood. I welcome your participation. Okay, guys, thank you. Now, moving back, election to exempt from the overseas that I've explained already. Controlled foreign companies. I can confirm that a CFC charge will not arise if J Limited is resident in Garia. However, I want to provide Lamar with an explanation of the purpose of the CFC rules and the charge that can be levied under them. Okay, so for that, if you visit my notes section, there's a separate section for the CFCs, controlled foreign companies. There it is, the controlled foreign companies. Above that, you can find the selection for overseas exemption as well. If a UK resident company makes the selection, its worldwide branches are exempt from these types of incomes. Losses will not be allowable. This election is irrevocable and can be made at any time. So this is the part above that. Then CFC. What is a CFC? As the name suggests, controlled foreign company. It means the company is in foreign country outside the UK, but it is mainly controlled by UK company. Now, obviously, guys, if it would have been directly controlled, it would have been considered as a permanent establishment and there is no need of a CFC charge. CFC charge is basically an anti-avoidance rule of HMRC, which is try to combat a trick that normally a taxpayer applies. Now, let me tell you what is the background. If the company is UK resident, I told you its worldwide profits are taxable in the UK, however, DTR is available. But obviously, if a company is non-UK resident, then it has no connection with the corporation tax. Now, what people try to do is they try to exploit the second part. They open a company which really does not have any connection directly with a UK company and claim that it is an overseas company. We do not have any control in that. We are not owning that company. To tell HMRC that it is not a company so that its profits cannot get taxed in the UK. Now, HMRC has certain tests which they apply to confirm that whether you're trying to deceive them or not. And these are different types of exemptions as well. You can read in my notes that if any of them applies, you can get away. However, HMRC only considers to think that whether it is a CFC or not if you have more than 25% of the stake in the company. If you own 10%, 5%, 18%, 16%, HMRC will not even bother to confirm that whether it is a CFC or not. The CFC legislation will only be applied if the UK company owns more than 25% of the company overseas. And even after owning more than 25%, there are various exemptions that you can apply for and still be able to get away from the corporation tax. So what I'll try to explain them are that if the companies are resident, their worldwide profits are taxable in the UK. However, if the countries are non-resident, companies are non-resident, they are not subject to UK tax, and people try to exploit the later bit, and that is why HMRC has come up with the CFC legislation. However, it only applies if you own more than 25% stake in a company overseas. So that's it. So I'll take you back to the notes, guys. Regarding this requirement, the answer will simply be this. Now, purchase of investment property. Explain the matters which Lamar would be aware in relation to the Rep Limited recovering the value added tax which would be incurred on the purchase of the property. There is no need to consider partial exemption or capital goods scheme. So I have already told that if he will opt to tax, he will be able to charge the VAT to the tenants. However, if the tenants are also VAT registered, they will not bother. If not, they will complain. That is the one thing. Then I've told you that the implications of opt to tax is that you have 6 months to think of. After that, the election will be revocable for 20 years. So these are the things that you'll be telling in this part. Now let's talk about the last part, that is for the IHT calculations. Before I open the spreadsheet and start calculating the IHT payable for this requirement, I would like everybody to raise their hand and tell me that they have understood till here so that I can start the calculations of IHT. Thank you, Johannes. Zainab, Tarek, Tamla, Johnson, Rubina, thank you. Okay, guys. Moving on, let's open the spreadsheet and the question along with that. So I'll close this manager's email. I'll also close the word processor. Let me adjust its size so that I can open the question along with that. Now, so guys, 60% of the shares and 80% before. So wealth before transfer and wealth after transfer. Before transfer, after transfer. All right, the values here. For the proposed gift, I'll be needing the values for that. Let me quickly check the extract from emails manager. There I have the values. If one has 80% holding, that is 75% or more, the share is worth of 24,000. So equals to 24 times 80,000. Okay guys, so it's 1920. After I have 60% holding and the value of 60% holding is 17 per share. So equals to 17 times 60,000. I can apply a minus sign as well. So transfer value equals to this plus this, 900,000. That is before the exemptions. Now, less annual exemptions. Let me check that are there any transfers immediately before this. So I have made the transfer in November 2020, and before that, yes, there is a transfer July 2020. Cash gift to sister. So because it is in the same tax year, it would have used all of my annual exemptions this year and for the previous year. So the annual exemptions will be zero. No annual exemptions available. Now, less NRB. NRB I have to check. It was 325,000 minus 170,000. But this is the cash value, not a transfer value, not the chargeable value. So that's why I have to adjust it with the annual exemption as well. So it will be 170,000 minus 6,000 as well. Here what I can do is 325,000 minus 164,000. So the nil rate band that would have left is 161. But the trick here is that we normally in a rhythm deduct all two exemptions, but always check that if there is any other transfer that was immediately before in the previous tax year, just to make sure that we have available both the exemptions. So if you see here, there is a transfer in 2016, that is the tax year 15-16. So it must have used the annual exemption of last year. So you would have only available this year's annual exemption. And if you have made the mistake but you were using the formula, it is not difficult to rectify your mistake. Sorry, it's yes, the 167 would have applied. So it's 158. Okay, guys. Now, just to make my calculations negative, I can apply this in the start of the bracket, and my taxable amount will be this chargeable amount, IHT at the rate 25% because Lamar has said that he'll be paying the tax. So this times 25%, 185,000. Now let's say if you were doing this question, because obviously I know about the standard answer, but if you don't and you made a mistake, that is you would have forgot to take the annual exemption before deducting the nil band, or you would have taken two annual exemptions, or you would have deducted the annual exemption here as well. So out of the total marks, you would have lose 2-3 marks, but about these calculation, you would have scored marks, whatever your amount is, and if you apply 25% on that, you'll score a mark using the own figure rule. So don't look about the negative things, look about the positive. I told you yesterday as well, when you'll be marking your answers yourself, do look for the points that you have done correctly. Now guys, with that I have finished the question. Can you guys raise your hands if you have understood the question completely, so that I can move on to read the mind of Marcus article. Okay guys, so let's talk about the article now. As I have recently downloaded, so here I have the article with me. I'll zoom it for you guys. Contents. Section A, question 1, updated to Finance Act 2020. Suggested solutions are available here as well. Marks awarded to candidate 1, marks awarded to candidate 2, as I told you that he has provided us with the two solutions. Now, insight into a marker's thinking, appreciating what we are trained to look for. That's what markers are saying to you. Obviously, it is not possible for one person to check the papers of students all over the world. So there is a complete marking team. This marking team gets briefed by the examiner at the start of the exam every time. And examiner tells their marking team that what they should be looking for in the exam. So the examiner has tried to tell you that what he always instruct to his markers to look for will help you fulfill your potential and gain the necessary mark to pass. Okay. Now this is the question. So I'll skip the question. And now he is telling you that A is the always case studies question, in that the line that I told you that each question will contain the marks with ethics, the examiner has written here as well, and he has himself emphasized on that if you are able to take 9 marks, look, with 9 marks available, 16 minutes of the 27 part B should be applicable to sub part 1. He's trying to tell you here the time management, but I'll skip that. I'll come here. Here you can see, guys, suggested solution updated to Finance Act. This is the standard solution with the maximum marks available. So I'll skip that because you can download this from the ACCA's past exam paper. The exact solution you can download from there. I'll take you to two candidates' answers that he has produced himself and told us that how much would he have rated those. The first, you can see that this is the meeting notes format. Knowledge obtained from advising the clients. These are the words that he has highlighted in the yellow are the ones that he'll be looking for. We have advised the client on trading in Garia, so we can use this expertise. Confidentiality is the fundamental principle of ethics. Cannot give any confidential details of our previous client. Can use our expertise gained. How much marks? 5 out of 5. And it is the answer of a candidate who has scored 27 marks out of 35. Moving on in part B, residency of J Limited. Here you can see that this student has tried to explain more than necessary that what is the criteria of permanent establishment. And if you read the article thoroughly, examiner has written that this student has wasted his precious time in explaining what was not required in the question. It was not required to explain what is the criteria of permanent establishment. So he has wasted some important minutes of the exam into election to exempt from overseas UK tax. This is a permanent and cannot be reversed is the keyword I'd be looking for. No corporation tax on Garia. Can't claim capital allowances or losses. 3 by 3. In CFC rules, you can clearly see that here he has started to explain what a CFC is, what are the CFC exemptions. In the answer, you can see that the examiner has told us that this student again has wasted time in explaining what the CFC rules are, what the normal exemptions are, where it was not required. And you can see he has given him 0 marks, 0 marks, 0 marks. Above, you can see he has given 0 marks for explaining what is the criteria of permanent establishment, 0 marks for that. He does not deduct your marks, but he don't give you marks. Now he has explained about capital gains tax and capital allowances. He has given him 0 marks because this was not asked here. And he has wasted time as well. Now, in opt to tax, purchase of investment property, if only opt to tax the building, this applies for 20 years. He has not explained about the cooling off period, thus he has lose the mark for that. You can see here. Then it applies for 20 years. Yes, he has taken the marks. Only out for tax, taken the marks. But lose marks for not mentioning that cooling off period. And if the tenants are VAT registered, they'll not bother whether getting charged the VAT on lease rental, and if they are not, they'll complain. Lost another mark. This part is entirely on calculations. If you do the calculations right, obviously you score. If you don't, then don't. You can see that this has done the mistake that what we have done. He has deducted the annual exemptions, so examiner has not given him any mark. Then he has calculated the NRB wrong. So he has not given him 0 mark. Instead, he has given him 0.5 mark. You can see here. And there was no mark for the final answer. So that's why it's written 0. Now, notes on candidates. One answer is a very good part of the article. We don't have time to go through the full article, but I have given you an insight what is happening in the article. I have also told students where they can download it because they were keep asking, sir, I'm unable to find that. I told you now. So I'll recommend you do study the candidates to answer, and after the answer use these notes that in which examiner has tried to tell you that where he has wasting the time, where he has lost marks, where he has explained more than necessary. These are the points that you should look for. It will help you a lot while self marking your exams. Now guys, I would like everybody to raise hand who have found this activity useful. Thank you guys. So we'll take a break. We'll be back after 10 minutes and then we'll start the next question. Meanwhile, if you guys have any question, you can put in the question section. Okay, guys, let's start. uh, Carla, as far as your question is concerned, unfortunately, I don't have the solutions. I normally solve them in the class with the students. So apologies for that. Rubina, I have told in the lecture as to how you can visit this article. It's that you have to go into the advanced taxation page on the ACC's website. In that, paper exam technique is the tab you should click on. And then you can find this article, ATX Read the Mind of the Marker article. So I hope it answers your question. So let's start the next question, guys. It's Grand Limited, as we have discussed. It is of September 18 attempt. There you can see Grand Limited, September 18 attempt. So I would like everybody to raise their hands if they're ready. Okay, guys. So we'll get out of this paper, and then in the ATX UK exam, the September 18 exam is available, from which we have attempted several questions. Almost all questions we have attempted. Akil and Damia was from here. Then there was another question. Now, the first question is obviously 35 mark question is Grand Limited. So let's read the requirements. Your manager has had a meeting with Bryce, the managing director of Grand Limited. Extracts from the email prepared by your manager following the meeting, together with the schedule information from Bryce, are set out in the exhibits. So, okay, so my manager has a meeting with Bryce, who is the MD of Grand Limited, and the information that he has collected is in the exhibits. So, the exhibit one is the email from my manager, in which obviously I'll be finding the detailed requirements, and in the second schedule of information from Bryce, I'll be finding the question itself. And in the requirement, obviously the marking scheme will be there. So let's quickly look at the requirements. Prepare the memorandum as requested in the email from your manager. The following marks are available. So guys, the format of memorandum is pretty critical in order to succeed in this requirement. So you should be well aware of that. That what is the format of memorandum. I'll discuss with you in a bit as well. So there's offer A in respect of sale of the company's shares. Then there's offer B in respect of the company's trade and asset. And the third requirement deal to VAT. The final requirement, tax evasion and tax avoidance, must have related to ethics part. So I can see that this 5 mark is related to ethics. On top of that, I'll be trying to take these 7 marks that are on VAT, along with 2 marks for the format of memorandum, and try to make my calculations as clear as possible, so that at least out of these 35 marks, 7 plus 5, 12 plus 4, 16 marks I can obtain at least easily. Then obviously I'll try to score maximum marks within the given time from these two parts that are, as compared to these parts, look tricky or maybe easy. That's what I'll find out when I'll read the question. Now I can have a quick look from the extract of my manager's email. So sale of Kolka Limited, then there's something related to offer A, offer B. Okay, then offer A's detailed requirement, then offer B's detailed requirement, and then the ethics part. The ethics part, normally, if you just read the detailed requirement, you can answer. Let's read the requirement and let's see that whether we can answer this by reading the detailed requirement or do we have to read the question. B and his daughter, who is a tax expert in the field of capital allowances, have drawn up a plan which they claim will enable a company to claim a tax reduction of 180% of the cost of a new machinery. So normally guys, what happens is that maximum 100% of the cost of an asset can be taken as a deduction or a capital allowance, but they have tried to come up with a scheme in which they can take at least up to 180% of the reduction. This plan is complicated and in that it involves the creation of new wholly owned subsidiaries and a series of contracts involving leasing and subleasing of the machinery between two companies. So it is a complex procedure, but somehow they have figured out a way. I have not looked at the plan in detail because even if it would appear to have the intended tax effect, I'm sure that it will fall within the general anti-abusive rules GAAR. Please prepare the notes which distinguish between tax evasion and tax avoidance and state the purpose of the GAAR. Explain why GAAR is likely to apply in this particular plan. Now guys, how many of you are aware of what GAAR is? Raise your hands. Good. Many students know about. Okay, however, for those who don't know, in the last of the ethics section of my notes, I have written about GAAR. They are general anti-abusive rules by HMRC that are made to combat abusive tax advantages. Abusive means the advantages that are not normally available for one, but one can come up with some extraordinary scheme through which they try to not only deceive HMRC but can take an undue advantage. So what I'll do is I'll try to explain both of these things to the person Bryce and his daughter that why it will fall into GAAR. But before that, I will tell them what is the difference between tax avoidance and tax evasion. Tax evasion means using the illegal sources or means to evade the tax, which is illegal and is a criminal offense. Avoiding, however, means using the legal ways or finding the legal ways to reduce the tax liability of yours. So, evasion is allowed avoidance is allowed, evasion is not because it is a criminal offense. So that is the difference between both. Now, I will explain him why it will fall into GAAR. So the reason is that in normal course, that maximum deduction against an asset that can be taken is 100%. However, they have tried to come up with a solution which is not only very complex, but also trying to take the advantages that is not available in the normal course. And whenever there is such advantage that one tries to take that is not normally available and tries a complex procedure, HMRC may rate that as an abusive arrangement. And if HMRC treats that as abusive arrangement, they may accelerate your tax payment, tax liability, delay your funds, or ignore artificial steps in abusive scheme. They can also charge you severe penalty that can be up to the 60% of the advantage. So these are the things that in general I will explain to Bryce and his daughter, and hence I can achieve easy 4 marks as far as the ethics part is concerned. So guys, have you understood? Quickly raise your hands because ethics is very important part. Okay, thank you. Now, moving back to the question. The other parts I'll rather not read I'll go to the extract from the client, the schedule information, and then I'll come back and then we'll read. However, I know that there are three proposals, proposal A, B, C. In C, I have to tell about VAT, and 1, 2. Let's see that what do I have to answer. Kolka details of assets. Okay, so this does not tell us the complete information. Email from my manager. Grand Limited has two wholly owned subsidiaries. Okay, Grand is the obviously company of Bryce, who is the MD of the company as well. Two wholly owned subsidiaries it has: Kolka Limited and Sosto Limited, C Limited and S Limited, and also owns shares in a number of other companies. Okay, all of the group companies are UK resident trading companies which prepare accounts to 31st March each year. All supplies made by the group are subject to value added tax at the standard rate. Okay, but before I move on, I would like you to tell you the format of the memorandum so that you can score some easy marks. It is available at the end of my notes as well. That is, you first have to write who the client is. So whatever the client is, then subject, then prepared by, and then date. Date I told you that it will be mentioned in the exam. And then for each heading, you can write below. However, if you have used the spreadsheet in between rather than using the table, you can write C spreadsheet like this. And then you can start solving the other requirements. Or if in between the requirement you are referring towards spreadsheet, you can. And in the spreadsheet, you can mention part that this is the part A's reference that I have given in the word processor. Because as I told you, normally more part of the question relates to the explanation, including there are some computations here and there, but the majority of the question relates to the explanation. Now, coming back, sale of Kolka Limited. Grant purchased the whole of the ordinary shares of Kolka Limited for 800,000 on 1st November 2013. The value of Kolka has fallen and the company is to be sold on 1st December 2021, which means that the company will be sold in loss. Two separate offers have been received, offer A and B. I guess that is what the earlier requirements deals with. Offer A: the purchaser will pay 70,000 for whole of the ordinary share capital of Kolka Limited. This amount will be reduced by any tax liabilities payable by Kolka Limited arising as a result of the company being sold. As the company is being sold at a loss, I doubt that there will be any tax liabilities, because even if you see that I have purchased it for 800,000 and now I'm getting 730 for that. So rather than me getting any gain out of that and having corporation tax on that, I'm selling it at a loss. But guys, if I would have sold it at a profit, would it then attracted any corporation tax or any exemption would have been available? Answer me in the question section. So if it I would have sold it at a profit, corporation tax, or if there wasn't any exemption available if the company would have even sold at a profit. Let's say I have sold it for 850,000 rather than 730. Now I've sold it on 50,000 profit. So on 50,000, I had to pay corporation tax, or is any exemption available? To remember, whenever you do a corporation tax question, there is one topic that gets tested extensively again, and again in the past exam papers. If you have attended or attempted the corporation tax questions from the Kaplan kit, and every second question you'll came across SSE, substantial shareholding exemption. Now I'll take you to my notes where it is mentioned to quickly revise that what the SSE is. There it is. SSE means whenever one company sells shares in another company and the holding in that company that we are selling is 10% or more, and we have owned that company for at least 12 months consistently out of the previous 6 years. If that is the case, if we sell the company, any gain that we realize in the result of that sale will not subject to corporation tax, rather it will be exempt. So two conditions is to be fulfilled. You must own 10% or more in the company, and you must keep it for more than 12 months in last 6 years. So 12 out of 6 years. If at any time you have consistently owned for 12 months, that is fine. Now, you tell me that if I would have sold it for 850,000, it is a wholly owned subsidiary of mine, Grand Limited. Kolka is wholly owned subsidiary of mine. If I have sold it on a profit, would have it attracted any corporation tax liability? Yes or no? No. And in every second question, I'm telling you again, in every second question, you'll came across SSE, substantial shareholding exemption is that important, and it has certain aspects. I'll urge you to practice a question called Helm Limited. It is on one of the exception that has been recently introduced in the Finance Act last year. So practice that. Then it has another exception as well that we'll be discussing in this question. Now, the rationale behind is that HMRC says because we give you substantial shareholding exemption, it is obvious even you do not have to claim it. So if those shares rather than at profit will be sold at loss, the loss will also not be allowable. Why? Because if you would have sold at profit, we are not charging you any tax. So if you will sell it at loss, we're not gonna give you any relief as well. So now you tell me that we are selling the company at a loss in the question. It is our wholly owned subsidiary. Will the loss be claimable or not? Good. However, you cannot say that the loss is not claimable straight away. You have to tell, because I told you that you have to imagine Bryce is sitting in front of you, whose company the uh, Grand Limited is. If you ask him no, he'll be shocked. You have to tell him that look, if you would have sold it at gain, there is an exemption called SSC that would have applied, which applies normally if you own more than 10% of the ownership in the company and keep it for 12 months. But if you sell the company or sell the shares at a loss, the loss because of the availability of exemption is also not available to adjust. That is one thing you'll tell him till now. Okay. Now, he has asked me what will be the money that I'll be getting after deducting any tax. So till now, there is no tax I can see. Rather, it is a loss, but it is not claimable. So the proceeds can be as it is. The amount of money he is receiving, he will not be paying any tax against it, but he will not be able to claim the losses as well. Till now, that is what the case. Now, I have also requested you to have a great emphasis on SSC and try to practice as many questions as you can of the corporation tax section in the Kaplan revision kit. Now, moving on. Offer B, the purchaser will pay 695,000 for the trade and assets of Kolka Limited. Now, rather than he buying the shares of my company, he'll only buy my assets. So obviously, I will sell him all of the assets, and if the net result resulted in gain, okay, I have to pay corporation tax on that. And if the net result is in losses, then I will claim that those losses as the capital losses, because he's now not buying the company completely, he's buying my trade and assets. So the company will remain on my name. He will buy all the operations and assets and will transfer against his company. In that, what I need is that what are the total assets, so I can compute gain for every asset, and on every asset that will be selling at gain, there'll be 19% corporation tax available on payable on that. So if I were to calculate after tax proceeds, I have to calculate the gain, then take 19% of all the assets or all the gain, then I'll deduct that 19% from the proceeds to calculate the after tax proceeds. So the building I have in Kolka's asset is Orabe building, ATL building, items of machinery, net current assets. One thing I am for sure that will not subject to any tax is net current assets, because they are not considered anywhere in the calculation of capital gains. So net current assets will be exempt. I'll ignore them. Okay. Now, there is further information respect of these assets is attached in the schedule from Bryce. Okay. So the value of Kolka Limited goodwill is negligible and should be ignored for the purpose of this work. That's fine. I'll ignore goodwill. Please prepare a memo for the client file regarding, first of all, offer A. So now this tells me in each offer, what do I have to write? So in offer A, I will first mention explanation of whether or not tax relief will be available in respect of the capital loss arising on the sale of shares. Okay, so what I'll be writing in the explanation on whether or not tax relief will be available, I'll be writing that the relief will not be available because of the availability of the SSE exemption. So the shares, if would have been sold at gain, they their gain would have been exempted. That's why the loss is not claimable also, due to the availability of SSE exemption. Second, an explanation of the tax implications of C Limited leaving the Grand Limited group list still owning the actual building. This explanation should not include any calculation. Okay, so I shall only discuss that what will be the impact of this thing. I have to check more detail about that what is the actual building. Normally what happens is, what comes into my mind is that normally what happens is that if you have bought any asset from any of your group member and he is your 75% capital gains group member, the asset normally transfers to you at an indexed cost, thus resulting in no gain, no loss. Because being a group member, you have the privilege to buy and sell asset within the company and pay no capital gains tax or no corporation tax on capital gains. But what happens is that if you have bought or sell any asset to the company that is now going out of the group, sometimes there are certain tax implications which needs to be done. So we'll discuss about it later. I think that A building would have been acquired at a, no, it's not a regrouping charge, it's a degrouping charge, Abraham. You're right. The topic is degrouping charge. We'll discuss that in detail in later. A calculation of the expected tax proceeds. So I have to just tell him in A that what will be the after tax proceeds, even my answer is wrong. If I have done the calculation, I'll score the marks for after tax proceeds. Offer B, in respect of sale of the company's trade and asset. What do I have to tell in that? A calculation of expected post tax proceeds again. In that I have to calculate the after tax proceeds. For this purpose, you should ignore any chargeable gains or allowable loss rising on the sale of the items of machinery. Okay, on the machinery, I shall ignore the losses or gains. In relation to the sale of the items of machinery, an explanation as to whether or not they will result in chargeable gains or allowable losses and of the availability of the rollover relief. So guys, I cannot comment currently until I came to learn that what is the type of machinery. I then can comment on that, whether a rollover relief will be available, loss or gain will be chargeable or available or not. An explanation of the companies to which Kolka can transfer any capital losses arising on the asset sold. That is pretty simple. That Kolka can transfer any capital loss on the asset sold to all of its gain group members. For example, I can see that he is in the group with Grand Limited and the S Limited. So these are the two companies that are mentioned in the question. I do not know whether it is a member of any other company as well. So I'll assume that if at least to these two companies, he can provide or transfer any capital loss if arised on the sale of the asset. Because in offer B, the person is only buying or trade in assets. So if they sold at a loss, the loss can be transferred to other gain group members. Note, when calculating the post-tax proceeds in respect of the two offers, you should assume that the relief rate of 19% will be obtained in respect of any capital losses. Okay, fine. If there will be any losses, I will be taking the relief at 19%. Offer B, value added tax. In respect of the B, as to whether or not Kolka Limited should charge VAT on the sale of its buildings and or its machinery. For that, still I need to know the nature of the building and the machinery. Then I can tell you. But I hope that if I find out, I can answer this requirement at least, because I'm always hoping for that the requirements, they are not that tricky. If I can get an idea what to write in that, it will be a blessing in the exam. So lastly, tax evasion and avoidance, that I have already answered. So let's now read the other schedule. I can open that side by side as well. Kolka uses both the Orabi and Atul buildings in its trade. It means that if we sell Kolka, both of the buildings will be sold with it as well. And if even we sell the trade and assets, we have to sell both of the buildings because both of the buildings are with Kolka. Fine. Orabi building and Atul building and machinery. Date of the purchase is February 14, April 19. Purchase cost, okay. Now I know I should know the market value of them so that I can calculate the gain. Value added, tax option to tax made. So Orabi building has not been opted to tax. Atul building has not been opted to tax as well, which means these buildings are exempt if not 3 years old. With Orabi building can definitely be exempt because it has been bought in 2014. Atul building, if it is a new commercial building, cannot be exempt if it is a new commercial building because it is bought on 1st April 2019, so the 3-year period has not elapsed. Now, on 31st December 2013, Kolka sold a machine of 74,000, resulting in the chargeable gain of 17,000. This gain was rolled over against the purchase of Orabi building. So guys, when I bought the Orabi building, I had a chargeable gain which I rolled over against Orabi building. Now you tell me, when I now sell the Orabi building, will that gain becomes chargeable? More answers. Will that gain become now chargeable? Because I am selling the Orabi building? Yes. And how will it become chargeable? It must have reduced the base cost of the building at that time. Because when you roll over the relief amount reduces the base cost of the new asset. So the price of the Orabi building is not 320,000, it is 320,000 minus 7,000 or 17,000 because its base cost is different, which is 303,000. So I'll open my scratch pad and I'll start writing my notes. Oribe building, or I can just write Oribe cost 320k minus 17k equals to 303k. I try to tell you in each question how to use the scratch pad. Please make sure to use it to make your notes while reading the question. You have now seen me or witnessed with me that it is pretty difficult to absorb that amount of information. I sometimes even forget a point. So it is always better that you write on scratchpad, making small notes for yourself. Moving on. Kolka purchased the 8 building from S Limited, that is also our group member, okay, for 255,000. Its market value at that time. As Kolka Limited and S Limited are both 100% subsidiaries of Grand Limited, the transfer of the building took place at no gain, no loss. So, guys, my question is when you buy anything from your group member, do you buy it at a cost or at a market value? Guys, you bought it at a cost or at a market value? At a cost always, okay? It means that if I have bought a building from my sister company, I must have bought it on a cost. The cost which is for the S Limited. Whatever the S Limited is cost is, they must have transferred to me on that cost. So whatever the market value is on that date when they have transferred it to me does not matter. What matters is that what was the cost on which S Limited bought the building for the very first time. That what's matter. Okay, as Kolka, okay now. S Limited purchased the building new and unused for 340,000 on January 18. So guys, you now tell me, shall I take 340 as my base cost or shall I take 255 as my base cost? 350 or 255? The cost on which S Limited bought the building or the market value on the date on which they transferred it to me? Do remember that S Limited is my gain group member. Come on, guys. Thank you, Tarek. You're right. Johannes, Rubina, Bella, you all are right. It is cost. Why the cost? Because whenever you transfer or you get something from your group member, you always get it on a cost. And some of you guys are saying index cost, and they are absolutely right. Index cost. But the thing is, guys, the building has been bought after 2018, December 2017, which means, Fawad, that the indexation has freezed on December 17. So any assets that are bought after that date does not have any indexation in it. So their cost will be the plain cost. Yes, if there is any asset that has been bought before December 17 and sold afterwards, only for them we're gonna consider the indexation. So you tell me, Fawad, that have I bought the A building after December 17? I've bought it in January 18. So obviously there will be no indexation. That is why I have not used the word indexed cost. So do remember that the company has received an asset from one of their group members at NGNL. NGNL means no gain, no loss. Whenever you received an asset from a gain group member and later on you as a company get out of the group, as per the rule of HMRC, if you have any asset in your possession at the time you're getting out of the group that you have received or purchased from any of your gain group members at no gain, no loss, a degrouping charge applies. Now, what is a degrouping charge? Let me take you to the notes. In that, if you go into 75% gain group section, here you can find what a degrouping charge is. A degrouping charge is applied if a shareholding of a company is sold in such a way that it no longer remains your group member, and that company has received an asset and NGNL from any of the company in the last 6 years. So it means that if you have any asset that you have bought more than 6 years ago, for that degrouping charge does not apply. And the last criteria is that these assets are still in your ownership. So guys, do you think that for this company, this building, that is A Limited, that criteria applies? We have bought the asset from a member company at NGNL, and that is within 6 years. Now the company is getting out of the group, so we have to apply a degrouping charge. How a degrouping charge is computed? We will go back on that date on which the company has received the asset from the other group member and assume that rather than it getting on NGNL, that is no gain no loss, what if it had acquired on a market value? What was the gain that would have arisen at that time? So we're going to take the market value on the date of transfer, and we will deduct allowable cost, and if there is any indexation we'll deduct that as well to calculate the gain. Whatever the gain is, that will be added into the proceeds of the company, and there will be corporation tax applicable on that. Now I'll get back to the question, and let's see that how much gain is there. So the market value at the time when S transferred the building to Kolka Limited was 255,000. That will be my proceeds. And the cost on which S Limited themselves bought the asset is 340. So rather than it getting on a gain, at that time Kolka Limited actually received it at a loss, or S Limited gave it to Kolka on a loss. Why is that? Because if I open a scratchpad with you guys, proceeds will be the market value, that is 230,000 mentioned in the question. Cost on which the S Limited bought themselves is 340,000, that is mentioned in the question. So it is a loss, guys, rather than a gain. How much? 110. 110,000 loss. Before I move on, it is a tricky point. I would like everybody to raise their hand that have they understood how I have computed the loss. Okay. So Johannes, you have said that if it would have been a gain, it would have added into the proceeds. Now you tell me it is now, rather than a gain, it is a loss. So what will happen with that? Didn't we deduct it from the proceeds now? What do you think, guys? When there is a degrouping charge, we add it to the proceeds. So now it is a loss. We will now deduct it from the proceeds. It will reduce our proceeds. The answer is yes. And how does it? Because if it gets added into the proceeds, there'll be a 19% corporation tax on that. Now it will be deducted from the proceeds, and there'll be a 19% corporation tax savings on that. So what I'll do is I'll take 19% of 1110 and I will deduct it from my proceeds, because rather than deducting, the 19% will effectively be the tax savings, so I will add it into the proceeds. There are two ways to do that. You can either decrease your proceeds with 110, or rather take the 19% of the proceeds and add it into the why I am taking 19% and adding it, because I'll be getting refund from HMRC of 19% on my losses, and it will increase my proceeds. Whenever there is a tax, it decreases your after tax proceeds. Whenever there is a loss, it increases your after tax proceeds. So it will increase my after tax proceeds, guys. So I can write on my scratch pad so I don't forget that times 19% equals to 20900, and add in proceeds. That is for the A building. However, as we are selling the C limited, so the first building will be sold as well, that is Orabai building. So Orabai building will be sold as well. Before computing the gain of Orabai building, I would like to ask you that this is the building that I have bought before December 17, and I am selling it after December 17. Now, Bella, this is not exempt due to SSC because I am talking about second offer here. In second offer, the person has buying our trade and assets, he's not buying our shares. Fawad, loss we are not adding in sales, we are adding the tax savings of loss in sales, because we have to calculate the after tax proceeds. So on loss, there will be a 19% tax savings. So I'll add it into the proceeds. I'm not adding loss directly into my sale. I'm adding tax savings, because whenever there's a tax, you deduct it from the proceeds and your after tax proceeds gets reduced. So there will be the opposite impact in the case of loss. Okay, now I was asking guys that the Orabai building I have bought before December 17 and I'm selling it after 17. So will I be calculating its indexed cost or not? Thank you. Now, out of the question, you guys help me which indexation allowance to take. I'll show you in the requirements. These are the indexation allowances. You help me which one to take. I can help you by telling you that I have bought the Orabai building in February 14. That's I can help you only. So now you tell me which one to take. You can take the figure and answer me in the question box. Thanks for your answer, Tariq. That was quick. Yes, the third one. We'll take the third one, third option, guys. That is from February 2014 to December 17. So I'll open my Scratchpad and I'll write there as well, because I have okay guys, so Scratchpad, in that I can write the cost in the question was, I have calculated here, the cost is 303. With 303, I'll multiply 0.094, I guess it was. Correct me if I'm wrong. So its indexation allowance will be, or what I can do is I can take 1.094. So it will result directly in the index cost with 303,000. 331,482 will be my index cost. 331,482 will be my indexed cost. Now all I have to do is, if I deduct the proceed out of that, I can calculate its gain. Why I'm doing that? Because when you'll be writing doing the question, it's always better for you to have a sketch first in your mind on the scratch pad, and then In the remaining time, try to convert it on the word processor or spreadsheet, whatever you prefer. Now, moving on. Let's open the schedules. I am done with almost Oribi building. All I have to do is from 320,000 deduct the indexed cost that I have calculated. Now, sorry, not from 320,000, whatever the proceeds are. Now, S Limited had purchased the A building. Okay, that I have done. I only left with point 0.3. All of the items of machinery are movable. The sale of the machinery will give rise to a balancing charge. Most of the items are worth less than their original cost. However, a small number of items are particularly specialized such that their market value exceeds their original cost. So guys, for plant and machinery, we have discussed yesterday as well that because they qualify for capital allowances, if they are to be sold at loss, their loss is not allowable because HMRC has already compensated you the decline in the value with capital allowances. However, if somehow they are sold at a value higher than their cost, there will be corporation tax that will be charged on it. So the tax will get charged if they are to be sold at gain. However, if they are sold at loss, there will be no loss allowable. That is one thing I'll tell him about the machinery. Second, I remember he has asked me regarding the rollover relief. About the rollover relief, guys, the rollover relief is normally available for the assets that are fixed. And as it is mentioned that the machinery is movable, it is highly unlikely that the remaining machinery that is above their market value, if we sell them as a part of Kolka building, we will not be able to claim the gain on them against the rollover relief. So what I'll mention is that for the machines, the ones that are to be sold less than their cost will not be their loss will not be allowable. The ones that will be sold at a higher than their cost, their gains, however, will be taxed. And as far as the rollover relief is concerned, it is normally available on the items that are fixed in nature. And as the machinery is movable, the rollover relief against them will not be available. Okay, guys, are you here with me till now? I know the 35 mark questions are a bit lengthy and they get sometimes boring as well because they take a lot of time. But what can we do? We have to practice them as well. They are the most integral part of the paper. So raise your hand if you're with me now till here. Okay, guys. Moving on. As I'm done with the questions, what I'll do is I'll read the requirements again to see that whether I have answered all the parts and start opening the spreadsheet and word processor for the any calculations that are necessary. So extract in the first an explanation whether or not tax relief that I have given. So I'll highlight this that I have answered this one. An explanation of tax implications of Kolka leaving the group list still owning the A building. Now I know that A building was basically received to Kolka by one of our group members. So we'll tell them that because it is clearly mentioned that we do not have to perform any calculations. So I'll just explain. I'll explain that because this asset has been received by one of the gain group member within the last 6 years, that is why at the departure of Kolka Limited from the group, if there is a gain on that asset, it will be chargeable and will be added to proceeds. However, in the question, it is there is a loss on A building, so that loss will increase the loss. However, due to the availability of SSE, that loss will not be allowable. Because in offer A, you remember that offer A relates to the sale of company's shares. So that is why in A, I have to discuss this, that if we sell the shares, there will be a degrouping charge loss, which should have increased the loss, but the shares, because the SSE is available, that is why the loss will not be claimable. So the loss on degrouping will go wasted in offer A. That is why he has not asked me to calculate as well, because there is no point of calculating the loss, because it will go waste as well anyways. So that is what I'm gonna mention in this second. So done with that. Any tax? Yes, there is one. Do remember that one, when you go out of the group and you have bought any asset from your group member in the last 6 years, the gain on that will be chargeable and will be added back to the proceeds. And if it is a building, specifically, if it is a building, then you have to check one more thing as well. That is, have you bought it in the last 3 years from any of the group member? If yes, then you have not only to add the degrouping charge gain as well, but you also have to add the stamp duty land tax as well. Now, why is that? Guys, the reason why HMRC adds that back is, if you would have purchased the building from anywhere or anyone outside the group, you would have to pay the stamp duty land tax. But because of buying this building from a group member, you were not only able to get away with the capital gains tax on that date, but you also didn't pay stamp duty land tax to HMRC. Now you're selling that company, so you not only have to return the relief of capital gains, but also pay the HMRC the relevant stamp duty that should have been paid by your company at that time of acquiring the building. Now I'll get back to the question. You tell me if you remember that it is clearly mentioned that we have bought the building on 1st April 2019. It is within 3 years. So don't you think, guys, that at the time of buying A Limited, we should have paid the stamp duty land tax, but because it is from our group member, we have not paid it. And now, because within of 3 years, we have to at least pay the stamp duty land tax to HMRC? Yes or no, guys? Yes. Thank you. So, to calculate the stamp duty land tax, this is the only tax that will be paid and will be deducted from the proceeds in scenario 1, because apart from that, there is no tax in scenario 1 because we are selling the shares at loss. So, there is no tax. So, what will be the stamp duty land tax? It is pretty easy. If you come into your tax and tables, click on tax tables, click on search and write stamp here. It will directly take you to the matches. There you go. So there you go, guys. Up to 150, but that is for non-residential properties and that is for residential properties and shares. So do remember that here we are calculating for non-residential properties. What do I mean by non-residential properties? Non-residential properties means commercial properties. For them, up to 150, it is 0%. Then from 150 to 250, that is the difference between them, is 100,000. On them it is 2%, and then the difference above that is at 5%. So let's see that what is the value of our building. at the time that when we have purchased. $255. So to calculate on 255, up till 150 I know it is 0%. Till from 250 to 150 it is 2%. So the difference between 250 and 150 will be 100,000. On 100,000 it is 2%. 100,000 into 2%. That is 2,000. Now for 5,000 that is above 250, it will be 5% plus 2,000. The total stamp duty land tax will be 2250. That is the only amount of tax that will be payable in requirement number A. So when I'll be answering requirement number A, I'll open the word processor here. Answering A, and in A, answering the last topic, that is post-tax proceeds. You would have written the answers to first two parts as well here, but I have skipped them, so I'll only do the third part. So I'll bold that. Proceeds are mentioned in the questions. I'll take that. Less SDLT, stamp duty land tax, that I have calculated recently as 2250. So post-tax proceeds equals to whatever the amount here is. Proceeds I can copy from the question. So let's open email from the manager. Offer A, the proceeds are 730,000. I'll copy them. And in the calculator, minus 730,000, it's 727,750. 727,750. So that we are done with offer A completely. We have told about the explanation of whether or not relief is available. No, it is not available because of SSE. Explanation of leaving the group. Degrouping charge will occur, but will go wasted because SSE, and post-tax proceeds are calculated as well. We are done with it. Let's talk about offer B, in which every asset needs to be calculated for gain and loss. But before that, let's first discuss offer B, and at the end I'll discuss offer B's this part. Let's first discuss the offer B's value added tax part. He's asking me, guys, an explanation as to whether or not Kolka Limited should charge VAT on the sale of its buildings or its machinery. Now you remember that there were two buildings, Orabai building and A building. Orabai building has not been opted to tax, and it is more than 3 years old building. Guys, is it an exempt building or not? Yes or no? Now, as it is an exempt building, Rubina, it is an exempt building because it is more than 3 years old. And it is clearly mentioned that the client has not opted it to tax. So it is an exempt building. So guys, as it is an exempt building, you tell me, can we charge VAT on that? No, we cannot. Okay. Now, let's talk about the second building, that A building. A building we have bought in 2019. It is less than 3 years old. Although it is not opted to tax, but because it is within first 3 years, it is a standard rated building. Shall we charge VAT on selling this building to the person, to whom we are giving all assets? Yes. Okay. The answer is yes. Now, guys, how will I explain it? You will start explaining that the buildings, commercial buildings that are more than 3 years old and are not opted to tax are exempt from are exempt from VAT. Therefore, the Orabai building being more than 3 years old and not opting to tax is an exempt, so therefore we cannot charge VAT on that. As far as the A building is concerned, because it is a new building and within 3 years it is a standard rated building, so we will apply VAT before selling it, or we will be charging the VAT before selling it. Okay, because it will be a standard rated supply. Now, another thing that I will discuss here is a topic called TOGC, transfer on going concern. Transfer on going concern means that if you sell the business to the other person on a going concern basis, which means if I go for either option A or option B and my business is going concern, then whenever you sell the business as a going concern, you do not have to charge the VAT on the sale of the asset. However, there are certain conditions that needs to be met. The first is obviously that the business should be transferred as a going concern. Second, the purchaser will use the assets in the same kind of business. Third, there should be no significant break. And last, the purchaser is also already VAT registered. If not, that he will become VAT registered. So in VAT question, I have mentioned that as well. Final registration of VAT. There it is. Final VAT registration charged need not to be levied if. Not to be levied means not to be charged. Final VAT charge not to be levied if the business is transferred as a going concern. There is no significant breaks between cessation and subsequent start of the trade. The nature of trade has not changed. New owner is either VAT registered or will register for VAT as soon as possible. So it is clearly mentioned here. So whenever you sell a business to someone and the question asks you that will we be charging the VAT on the sale of the business, always you answer this to them. Okay, guys. So that will be your answer to them. Now, coming back to the question, I'll open the schedule. I have answered this. I have answered this as well. Now, the only thing I'm left with is offer B's calculation of post-tax proceeds. So let's proceed to that. I'll rather prefer a spreadsheet for that type of calculation. Now, I will refer here. When I'll be writing the answer to this question in the word processor, I'll write there C spreadsheet, and here I will give the reference that proposal B this is. Now, I have to copy some data from the question. that is the expected values of the asset on that date. So this asset will be subject to gains. This items of the machinery I will ignore, and current assets I will ignore. On items of the machinery, it was mentioned that there is a balancing charge. I will take that balancing charge obviously, but because of their depreciable in nature, I cannot take them or their loss. And net current asset I'll ignore because they are exempt from CGT. So Oribai building 410 is the market value, and for Etual 230 is the market value. So I'll write here Oribai building and Etual building. Then there's a balancing charge in the question, and if there will be any loss, I will consider that as well while the calculation. Now, before that, this all will matter later. First, I have to write the proceeds that I'll be getting, because my major aim is to calculate after tax proceeds here. So what will be my proceeds in the second option? It is 695,000. So if I can copy that, 695,000. Okay. For Oribai building, see my working, and my working is here. Proceeds, I have to visit the question. For 10,000, I can copy that. Less indexed cost. I have calculated that already on my scratch pad. So if I can open that, there you go, 331,482. So I can tell examiner that it was basically 320,000, from which I have deducted 17,000 the chargeable gain, and I have multiplied it by 1.094, that was the indexation allowance, and I calculated 331,482. Let's put a minus sign here. Okay guys, so the gain on the Orabai building will be this. CT at 19% will be this. So due to this, my after tax proceeds will be decreased. So I'll take this because it will decrease my after tax proceeds. Because if I receive 695,000 lump sum from that person and gives him all the trade and assets, but to HMRC, out of those proceeds, I have to pay the tax from on which assets I have received the gain. However, I'll be also receiving the loss relief as well on the asset on which I have received the loss. For example, a building. On a building, you guys know that I have received a loss, and on Scratchpad, I have calculated the loss as well. It is 110. So for a building, I can tell examiner that its cost was 340 in the question. Out of that, sorry, the proceeds were 230. So 230 first minus 340 So this resulting in loss 10,000. However, I will also multiply here 19% because I'll take the CT savings. I remember I have calculated the CT savings on my scratch pad as well. 20900. So minus positive 20900. Fawad, I guess you asked me, sir, why will I add the proceeds? If do you now get my point that I have added because it will result in savings? If yes, then please answer in the question box. Now, please quickly raise hands if you are with me till now, guys. I know it was a bit boring and lengthy, but that's how 35 mark questions are. So please raise your hands. Thank you. Glad to see that you're with me. Now, for balancing charge, I have to go back and see that what was the balancing charge in the question. All of the items in the machinery are movable and will give rise to balancing charge of 12,100. So the balancing charge is 12,100. So 12,100 will also give rise to 19% of corporation tax equals to negative 12,100 into 19% because this will result in tax as well. So three figures I have taken. From that, post tax proceeds sum all of these 698,863 will be my post tax proceeds. So with that, I'll go back into the question, open the email. For offer B, I have told the calculation of expected post-tax proceeds. Now, the second requirement is in relation to the sale of the items of machinery, an explanation as whether or not they will result in chargeable gains. So that I have explained, guys, that all of the items in the plant and machinery that are less than their cost, no loss relief. The ones that are more than their cost, there will be a chargeable gain on them, and allowable loss cannot be taken as they are assets of depreciable nature. And rollover relief is also not available because the assets are movable rather than fixed. So this can be answered as well. The second part. Now, for the third part, an explanation of the companies to which Kolka Limited can transfer any capital loss on the assets sold. Now, guys, you know that in the very start of the question, we have read that S Limited, Kolka Limited, and Grand Limited formed the group, and there are some other companies as well that are also part of the group. So, as far as the loss is concerned, all of the companies that are in their 75% gain group members, any capital loss on trade and assets in option B can be surrendered to any of their group members that are within their 75% gain group, or any company in which if they do not have the direct 75% holding, if they can have an effective 51% of holding as well, that will work as well because that company will also be treated as the capital gain group member. With that, guys, I have summed up this question. It was there was there were two complete 35 mark questions that I have gone through with you guys. So I would like to have your feedback by raising your hands that was it helpful? Thank you. Now, I'll spare 5 minutes to to answer your questions. If you have any questions, please ask them in the question section. Guys, when you are watching the webinar, or I'll suggest you to watch recording as well, don't only focus on the treatments that I'm solving. Also try to learn how am I using the word processor, how am I using the spreadsheet, how am I using these both. In the read, how am I using the scratch pad, how I'm using the highlighter function, because you have to admit that these are only your tools that you have to use in the exam. So you have to come out that traditional paper and pen approach, because unfortunately they will not be available. However, the students that are sitting in the remote invigilation, I do not know whether ACCA will allow them to have a pen or paper with them. That's you have to find out. But if you have, then obviously it will be helpful. Otherwise, I will suggest you to get yourself familiarized with these sort of things. Thank you, Bella, for telling that it is not allowed. So you should know that you should familiarize yourself with this thing. I guess the it is now official that the exams are going to be remote invigilation in many of the areas, especially in Pakistan. And ACC is also conducting a webinar on Saturday to tell students about that. I will request you to attend that webinar as well. Rubina, I've told you, let me tell you again that when you'll go into the ATX section, you have seen here, there is a section called paper exam technique. You just have to click on that. Or you can directly write on the Google UK ATX read the mind of marker article. It will directly take you to this page. From there you can download that. Any more questions, students? Okay, so I will suggest you some tips that will now help you on the paper or for preparing the paper. Try to solve the past exam papers and the specimen exam here that is available in practice to platform. ACCA CB practice platform, do it and these questions. Apart from that, on daily basis, do a 120 mark question from any part of the syllabus, do a 135 mark question, and do a 125 mark question. What this will help you is to manage all types of question in a day, similar to you have similar to which you have to deal with in the exam as well. So that is what I suggest. Second thing, read notes once at least before trying to attempt the kit. But do not go through the notes again and again and again and again. If you think that you can learn the rules by visiting or learning the notes, you're wrong. The best way to learn the rules is to attempt the question. Think what I'm going to tell you. Whenever you attempt a question, you get stuck on something, you then either open the answer from the back of the revision kit or open your notes and learn the rule and then try to attempt the question. You never again forget that rule. However, if you keep reading rule and one day I'll give you a question and ask you to identify which rules apply in this question, will not be able to highlight. So get out of this myth that the best way to learn the rules is to read the notes again and again and again and again. Number one. Number two, while solving the paper, before going into the paper, Do admit that you must have many topics that you are not good at. Everybody has. That's what not matter. What matters is that out of the 100 marks, what are the topics on which you have either a good grip or at least an okay grip, out of which you are able to take or extract marks because of your good exam technique, rather than just focusing, oh, I don't know this topic, I do not know about this topic, what if this comes into exam? Nothing happens. Even if the paper comes out of for 20 marks on from those questions for which you don't know anything about, still you have the 80 marks, and out of that you have to score 50. You do not have to score 70 out of 80. So always think like that, that I shall focus on the topics about which I know. So in your practice routine, incorporate all type of question. Try to read the notes at once, but do not read the notes again and again. Always, whenever you are attempting the questions from the Kaplan's kit, after that, they have always pasted the examiner reports. Do read the examiner reports. You can came to learn what was the examiner's feedback about the answers. Then there are tutor top tips. Do read about the tutor top tips as well. The reason I'm telling you these things, because tomorrow is the last day, and if we were unable to spare some time for these things, I may not be able to help you. So it's better that today we have 5 minutes left. If you have any questions, you can ask me in the question section. Okay, guys. I hope that today's lecture have helped you. I would like to sign off now, and I wish you best of luck and hope to see you tomorrow for the last day. I pray and I wish you the best of luck, and I hope that these sessions helped you a lot and you may succeed in your exam. So best of luck. Hope to see you tomorrow. Take care. Bye.